What's up, guys? In today's video, I'm going to explain whole life insurance versus universal life insurance. So these are two different forms of permanent life insurance, and I'm going to explain the pros and cons of each one. So with that, let's just get started in the video. Okay, before I talk about whole life insurance versus universal life insurance, I just want to say a few quick things about permanent life insurance. So if you're on this video, chances are you've already researched permanent life insurance a little bit, and you think maybe it is right for you, maybe it's not right for you. I'll just weigh my 2 cents about permanent life insurance and who it's right for. So really, permanent life insurance is for people that are looking towards estate planning. Okay, so what I mean by that is they're looking at maybe taxation upon death and they need some liquidity to pay for those taxes upon death. Maybe they want to leave something behind to their children or their grandchildren. Maybe they want to leave something behind to a charity. Now, the question comes up quite often, invest in life insurance. Okay, so you might hear a lot of insurance advisors or financial agents make the suggestion that when you're young, you should purchase a permanent life insurance policy because there's an investment component to it and you can use that later on in your life. Now, that is a very complicated subject area, and I made a long 40-minute video specifically on that because the answer is not black and white. There's no one size fits all, and that's one of the big problems I have with a lot of people in this industry is they say like one size fits all, like you should invest in this or you should do that. It's like, well, no, your specific scenario and your specific situation dictates a lot of the things that we should do. So giving a one-size-fits-all answer doesn't work. If you want to watch that video, I'll link it here. The title of that video is life insurance a good investment? And the answer is just complicated. It's a long video. So with that being said, let's talk in this video about permanent life insurance, and let's not assume any type of investment component. All we're going to assume is that you're looking towards estate planning, you want liquidity upon death, and you have a need for permanent life insurance, and you want to know should you have whole life or universal life. Nothing about investments. If you want to look up that video, I'll link it right there. By the way, before we go on, if you wanted to obtain instant life insurance quotes, term life insurance quotes, you can visit affinitylife.ca, and I'll put the link in the description below, and you can view quotes online instantly without putting in your email or your phone number, and you can apply for them online as well. So I'll put that in the description below. Okay, so you've decided that you definitely want permanent life insurance and you're trying to decide between whole life insurance and permanent life insurance. Okay, let's talk about whole life insurance first. By the way, I made a longer video talking about whole life insurance and I'll post it here, but I'll just give you a quick overview. So whole life insurance has two different kinds. There's non-participating whole life insurance and there's participating whole life insurance. Non-participating is typically a little bit cheaper. Participating is a little bit more expensive, but you get to participate in the profits of the insurance company and they'll return that to you in what's known as a dividend, a life insurance dividend. And there's a couple different options. There's 5 different options that you can pick. The most common options are paid up additions, and what that means is that your face amount will grow over time. Another one that's quite common is something called enhanced insurance edition, and that's kind of a way to still have the paid up additions, but it's cheaper in the beginning. So there's a couple different options there. Most people I see are going with the participating life insurance option, but that's not to say that some people don't have the non-participating. Whole life insurance has a mechanism known as cash surrender value. So cash surrender value is an interesting mechanic. A lot of people have a lot of questions about what is cash surrender value? What can I do with it? How do I utilize it? Do I get it upon death? The easiest way to think about cash surrender value is kind of like the equity within your home. Okay, so if you own a house and you had equity within it, maybe $100,000, well, you can't just take that money out of your house. There's a couple of different ways you could do it. The most common way is a line of credit. So cash surrender value has the same different mechanisms. So there's policy loans and collateral loans you can take against it if you would like, but it can get a little bit complicated. Again, I made a long video about investing in life insurance where I explain all this, so I don't want to get too much into it, but just know those options are available. And then the third way that you can access it is if you cancel your policy, you can essentially receive that full amount of cash surrender value, and the insurance company will write you a check and pay this to you. However, it might be taxable. Now, the real advantage of whole life insurance is that it's simple and easy to understand and it's guaranteed. So whole life insurance has different payment periods that you can choose. So there's things known as 8 pay, 10 pay, 15 pay, 20 pay. Those are some common terms. And so what that means is you can really think about that like the mortgage on your home. You pay the mortgage during the 25 or 30-year term. When you're done paying the mortgage, it's paid off, you now own the home. Well, the same thing with whole life insurance. you can pick a term. So let's say that 20 years is the term that you want to go with. You pay the premiums during those 20 years. And if you pass away during those 20 years, your death benefit will obviously get paid out. But after those 20 years, something interesting happens where you're done paying for the policy. So what that means is it's paid for, and now you no longer have to pay for it ever again, but you own that policy, meaning that when you pass away, whether it be 30 years down the road, 50 years down the road, whenever it is, that policy is paid for, it's done, you set it and forget it, you no longer need to worry about it anymore. So whole life insurance is really right for people that are looking for something that's guaranteed, it's easy to understand, they pay the premiums, and once the premiums are done being paid, they own the policy and it'll get paid out whenever. You don't need to manage it. All you need to do is just pay the premium on time, pay it for the set duration. At the end of that duration, the policy's paid off. Whenever you pass away, the benefit will get paid out to your beneficiaries. It's very easy to understand. It's simple. You don't need to manage it, okay? The downside to it is that compared to universal life insurance, for the same dollar for dollar benefit, it can be more expensive, okay? But I'm gonna talk about universal life insurance and what are the pros and cons to that. So universal life insurance is a little bit more complicated of a product. So again, I made a longer video and I'll post it right there. You can watch that, I think it's 15 minutes long, where I kind of really dive into the nitty gritty of universal life insurance. But suffice to say, in a nutshell, this is how universal life insurance works, okay? You have two different components and they're what we call unbundled. What that means is they're very flexible. You can change a little bit of this one, you can change a little bit of this one. It's untied, it's flexible, and it really allows some creativity in the designing of the product and the designing of your specific policy. Whereas whole life is very much, this is the box. If you fit in the box, good. And it's like a black hole of the insurance company. They do their thing and you get whatever at the end of the day. And it's not really clear what happens, okay? But it's simple and easy to understand because they deal with everything. With universal life insurance, however, you get to pick it as the client. So the first component is cost of insurance. Now there's two different kinds of cost of insurance. There's what we call YRT, which stands for yearly renewable term. And all this means is that each year it will increase whatever your age is in that year. So if you're 39, then it will be based on a 39-year-old, and then the next year a 40-year-old, 41, 42, 43, 44. Okay, well the benefit of that is that in the beginning of your policy, the cost of insurance is very inexpensive, okay? But later on, as you get older, it can get more and more expensive. So a general theory or general rule of thumb is you want to do YRT in the early years, and then the second type of cost of insurance is level. And all that means is level to age 100, meaning that it's going to be the exact same premium all the way up until the end. With that being a level premium, however, the cost is going to be a little bit more expensive, but it's going to be a fixed cost, meaning the same, okay? So again, I mentioned a general rule of thumb is that you can have YRT in the beginning and then switch it to level maybe a little bit later on. And I do talk a lot more in depth of that in the other video that I made. So if that's a little over your head, go watch that video. Now, the second component is this investment fund. Whereas whole life has this cash surrender value, a UL has this investment fund. And this is where it gets really flexible. So you can pick a premium that you would like. Let's say $100 a month. And you can allocate maybe $30 of that premium into the cost of insurance, and the other $70 you can put into this investment fund. And this investment fund essentially tracks different markets and different investment funds that you can choose. So you could choose the S&P 500, you could choose different index funds, you could choose equities, you could choose fixed incomes. It's totally flexible. It's up to you as the client to choose what you'd like to do, okay? And now the theory of universal life insurance is that it's this unbundled, flexible, permanent life insurance policy where you as the client are growing this investment account to a point where the returns from that can essentially pay for the cost of insurance, okay? Now, with all this flexibility, dollar for dollar, it can be cheaper than a whole life. Because if you get really good returns within your investment account and you manage it properly and you choose good investments, then this can grow quite substantially, and it's all tax exempt within certain limits or over time. And then you can use that investment account to pay for the cost of insurance, essentially creating your own fixed duration of payments, right? But there's no guarantees. So with whole life, there's guarantees. With universal life, it's totally flexible and you get to manage it. So maybe instead of a duration of 20 years, maybe you can choose really good investments, and in 15 years, you no longer need to pay anymore because the investment account is getting so much returns that it's paying for the cost of insurance. But on the flip side, maybe it's not doing so well. Maybe it's bad investments that it's in, and instead of a 20-year, you're doing 25 years. So the pros of universal life insurance is that it's extremely flexible. It's a little bit cheaper, for sure dollar for dollar on face amount, and you just have way more options to choose from. The downside is though, it's more complicated and you need to manage it. And I'm just gonna do a quick little rant here about universal life insurance and some of the problems that I have with it personally. Okay, most advisors that get into the industry, and I hate to say this, but this is just the nature of the financial industry, especially in the insurance industry, will quit the industry. 90% of advisors that come into the industry are gone within 5 years. So what does that mean for you as a client? It means that if you personally are going to buy a universal life insurance policy, do not rely on your advisor managing this policy, because chances are they're going to quit the industry. And if they don't quit the industry and they do somehow survive and make it through, what are the chances they're still gonna be around managing your policy? It's just slim to none, and I'm being honest. So if you want to choose a universal life insurance policy, which you totally can, just make sure that you understand it very well and you know how to manage it, okay? So who is universal life insurance right for? It's really right for the person who's a little bit more of a sophisticated investor. They want more control over their investments and over their life insurance policy. They want the flexibility, and they're okay taking a little bit more risk to get better returns within their policy, and maybe have a less payment period or a shorter payment period than a whole life, and maybe a higher return than a whole life, depending on how they manage it, okay? So I hope that gave you a good overview of the difference between whole life and universal life. I hope you guys enjoyed this video. If you guys enjoy this content, all I ask is that you give a thumbs up, and I'll see you guys in the next video. Take care. Yep. Barely any coffee left. Okay, before I talk about whole life insurance. By the way, before we go on, if you wanted to look up, no, how am I gonna say this?